Hello, everyone. Welcome. Today we'll be solving question 4 from the Comm 217 Winter 2014 final examination. So question 4 is about long-term assets or non-current assets. 14 marks, 30 minutes. It's a pretty straightforward question. So what we're presented here is some information about a purchase of various assets in 2010. So we bought some land and a building for $270. We incurred some costs to prepare the assets for use. We incurred some other costs. So let's just go through each of these costs, okay, and identify what they are for. So the 237 is for land and building. The legal fees for closing is also for land and building. Renovation cost for the building is for building only. The $1,000 opening ceremony costs, these are simply expenses. They're promo costs, and they would be expense like any other expense like advertising or that kind of revenue expense, so it's not capitalized at all. We bought some warehouse equipment, so that's equipment. And delivery of the new warehouse equipment, well, this is also considered as part of the cost of the equipment, because if you can't, if the equipment is not delivered, then you can't use it for your operation. So the whole purpose of analyzing these costs is to identify which ones should be capitalized to the asset. Okay, and the general rule is that any costs that are incurred that are necessary to prepare the asset for use should be added to the cost of the asset. Okay, so what you can see here then is this is a basket purchase where you're paying one lump sum for two assets. And here we're buying a land and a building. So what we're going to need to do very soon is split this cost and allocate a portion of it to the land and a portion of it to the building. Okay, so we've got all our costs, additional information. The year end is December 31st. And depreciation for all of this equipment. New warehouse equipment is started from June 1st, 2011. Market value for the land is $102,000 respectively. So this is market value. Okay, so the first requirement is to determine the cost of the land. Okay, so we're going to do this down here. Okay, so required number 1. So what is the land cost? Well, we have land, building, and equipment. Okay, I'm doing this now because we will need all this information later. So let's look at the $237,000. Okay, this was used to purchase the land and the building. Okay, so we're going to have to allocate this to the land and the building based on using some kind of a method. And the method that we usually use to do this is the relative fair market value. Okay, so the fair market value for the land, we're told, is $100,000, and for the building, it's $200,000. So this is $300,000 in total. Okay, so 100 over 300, or 1/3, is the relative fair market value of the land. And we're going to use this ratio to determine the cost of the land. Okay, so just let me get back here a bit, so because I forgot to do this. So the total basket purchase is $240. Okay, so just to clarify again, we paid $237 for the land, and we had to pay an additional $3,000 for closing. Okay, so these two, you can see I've identified them up here, they both belong to the land and building. So the cost that we're going to allocate is not $237, but $240,000. And for the building, 200 over 300 at $240. Okay, so this 240 is split 80,000 for the land and 160 for the building. Okay, these two total 240. Okay, we can't record the land or the building based on the fair market value because that's not what we paid for them. The historical cost principle requires that we record the value of an asset based on what we paid for it. So the historical cost. The cost to us was 240. So and it's split between land of 80 and building of 160. Okay, so that takes care of the first two items here. Renovation costs for the building. Well, that's a cost. Let's just put it down here. That's exclusively for the building. So we could just add that in the second column here in the building column. The 1,000 promo cost, as I said before, this is a regular expense against revenue and not to be capitalized. The warehouse equipment of 50,000 plus 5, so we're looking at 55,000 here for the equipment. So 55,000. There's no need to split that up using fair market value. It was all spent on the equipment exclusively. Okay, so as you can see, our capitalized cost for land is 80, and our capitalized cost for building is 209, and for equipment it's 55. Okay, so in order to, for question required number 1, okay, the correct answer is 80,000. So the cost of the land here is 80,000. Okay, so let's move on to requirement number 2. They're asking us to estimate the depreciation for the building. Okay, using the straight line rate. So we know that this is one of many depreciation methods. So let's just remind ourselves how to compute that. It's cost minus residual value over useful life. Okay, so if we go back to our worksheet on page 1, we computed the cost of the building to be $209,000. The residual value here is given in the question itself. The useful life is 30 years. Residual value is 50. So residual value is 50 over 30 years. Okay, so that gives us 159 over 30, which is equal to $5,300 of depreciation per year. Okay, so that answers question number 2. Okay, so the estimated depreciation using straight line method is $5,300 per year. Okay, so that's pretty straightforward. The third requirement, okay, now we're moving over to the equipment. Required, if you remember, requirement 1 dealt with the land, required number 2 with the building. Now in required 3, we're talking about the equipment. Okay, so this equipment had a cost, initial cost of $55,000. Okay, so what's happening with this equipment that was initially, its original cost was $55,000. In year 1, we use the units of production method to depreciate the asset. And they're telling you 1 year later, they switched to double declining method. So they switched to double declining balance method of depreciation. Okay, so this is a change in depreciation method. Okay, so change in depreciation method. Okay, and what they're asking you to do is compute, okay, the amount of depreciation for the equipment after the second year of use. So the first year of use, again, they use units of production. And at the end of the first year, they switch to double declining balance method, and they're asking you to compute the depreciation for the second year, the year of the change. Okay, so in order to do this, okay, we've got to go right back to the beginning of when the equipment was purchased and figure out what's gone on since we acquired the equipment, because when we have a change in depreciation method, we need to determine the carrying value of the asset on the date of change. Okay, and the carrying value is simply the cost minus the accumulated depreciation. Okay, so we've got to figure out what the carrying value was on the date of change. So we've got to go back to year one and determine the carrying value. So we know that this is 55,000, but we don't know what this is during year one. So let's go back and compute actually what happened during that year. So the cost was 55,000. Okay, and in year one, we computed our depreciation based on the units of production method. Okay, so in year one, there was an estimate of 100,000 units. So the useful life of this equipment, okay, was that it would produce up to 100,000 units over its useful life. Okay, and that the residual value would be 5,000. So the rate, okay, that I'm going to compute here is this. So the cost minus the residual value of, okay, we know what it is, so I'm just going to put it in right now. Minus 5,000 residual value over the 100,000 units over its total life gives me a rate of 50 cents per unit. Okay, and this 50 cents per unit is the rate I'm going to use to compute my depreciation. So for every unit that we produce, we are going to depreciate this equipment at the rate of 50 cents per unit. Okay, so in year one, okay, 50 cents per unit. How many units did we produce? Well, we were told 20,000 units. Okay, so in year one, my depreciation, I'm just going to move this over here to give me more space. So our cost is 55,000. My year one depreciation using the units of production method, okay, would have been $10,000. Okay, because this is equal to 10,000. So this is depreciation year one using the units of production method. Okay, so that means the carrying value, okay, at the end of year one or at the beginning of year two is $45,000. Okay, so this is the carrying value at the end of year one or at the beginning of year two. Okay, so at the end of year one or the beginning of year two, this is where we have the change. So in year two, okay, we're changing methods. So when you change methods, again, you have to determine the carrying value and start from zero again. So let's assume we've acquired this asset at a cost of 45. So the new depreciation method will be based on the carrying value. So what we need to do is they're using double declining balance method. Okay, so it's twice times the straight line rate. So we are told that the equipment will last for 3 years. Okay, so the 2 times the straight line rate is 2/3. Okay, so the depreciation taken in year two using this method would be 45,000, the carrying value, times the rate of 2/3, which is equal to $30,000. And this is depreciation year two. Okay, in the double declining balance method, we don't take into consideration the residual value. It's simply carrying value 45 times the double declining balance rate, which is 2/3. So our depreciation is 2/3 of 45, so 30,000. So the carrying value at the end of year 2 is $15,000. Okay, so the depreciation taken in year 2 is $30,000. Okay, so let's go back and see what the fourth requirement is. So again, we've just finished answering number 3. So the fourth one is that after one additional year at the end of 2013, the company sells the warehouse equipment for $10,000. Okay, we're asked to prepare the journal entry for the transaction. Okay, so what is going to happen, okay, is this. So this is required number 4. Okay, we sell the equipment for $10,000. Okay, so what happens when we have a disposal, okay, there's a couple of things we have to do. We need to record the cash received, okay, and we need to remove the asset and related accounts from the books. Okay. Why? Because we no longer own the asset. Somebody else owns it. Remember, the definition of an asset is A, you own the asset, and B, it has future economic value. So what you've essentially done is you've exchanged one asset, your equipment, for another, for cash. Okay, so you gave up your asset in return for cash. Now, if there's a difference between the book value of this, what you gave up compared to what you got in return, there could be a gain or a loss. Okay, so let's go back to the details of this question. So, and let's just recreate what's happened again with this warehouse equipment. Remember, the initial cost we got was $55,000. And in 2011, we were using the straight line method. And if you recall, we computed depreciation of $10,000 for that year. In 2012, we changed to double declining balance method. And the depreciation recorded for that year was $30,000. Okay? And here we are 1 year later, at the end of 2013. And then we sell it. Okay, so what we need to do, first of all, so at the beginning of, let me go back here. At the beginning of 2013, we've taken $40,000 of depreciation, which means the carrying value of the asset is $15,000. Okay, at the start of 2013. Okay, during 2013 we use the asset, and at the end of 2013 we sell it. Okay, so this is the story that's related to this asset. Okay, so before we sell it, okay, we have to record the depreciation for the time period that we used it. So in this case, we need to record depreciation for an entire year. So the first thing we need to do is bring the depreciation up to date, okay, which means in this case for 12 months, all of 2013, okay, because we sold it at the end of the year. Okay, so let's figure out, and this is a little tricky because we have to take into consideration residual value. Okay, remember the rule is you cannot depreciate beyond residual value. In this case, the residual value is equal to $6,000. Okay, so in 2013, we're still using the double declining balance. Okay, so let's compute the depreciation for 2013. Okay, my carrying value is 15,000, and my rate, okay, my double declining balance rate is 2 times the straight line rate, which is 2/3. So that gives me a depreciation of $10,000 for 2013. Okay, but, and this is the tricky part, but this would result in a carrying value of $5,000, right? Because we have 15,000. If I put $10,000 here, my new carrying value would be 5,000. Okay, I can't do this because it's below, which is below my residual value of 6,000. Okay, so the maximum I can take is not 10,000. My maximum is 9,000. Okay, so I'm just going to go and erase this here. So let's go back here. So 15,000, oops, let me just correct that. So the maximum depreciation I could take is $9,000, okay? And that leaves me with a carrying value of $6,000. Again, this is the max. It's not 10,000, but 9,000. Okay? Because again, you cannot depreciate an asset beyond its carrying value. Okay? So if the carrying value, if we depreciated 10,000, this would be 5, which is not correct. Okay? So the maximum for 2013 is $9,000, which leaves us with a carrying value of 6,000. Okay, so now when we've updated our depreciation for the year, so the carrying value is 6,000. The cash received is 10,000. Okay, so you can see right away we've given up an asset that's worth 6,000 for 10,000. So we have a gain. Okay. So the entry to record this gain or this disposal is, well, we've got to record the fact that we've received some cash for 10,000. Okay. We've got to remove the asset from our books. Okay, and for this I'm just going to make a T account. So this is the equipment, okay, which has a gross cost of 55,000. Oops, let me just, equipment, this was the original cost, and the equipment accumulated depreciation. So in year 1, as I said before, we took 10,000, year 2, 30,000, and year 3, 9,000. So I have $49,000 of accumulated depreciation on equipment that was recorded at 55,000. Okay, so what you've got to do is get rid of these amounts on your books again because you no longer own the asset. Okay, so we're receiving 10,000. How do we get rid of a debit here? Well, we credit the account. So I'm going to simply credit the equipment for $55,000. How do I get rid of this accumulated depreciation? Well, it's a credit, so I'm going to debit the account. $49,000. Okay, so my entry doesn't balance, and that's because I've exchanged something that has a net book value of $6,000 for a $10,000, another $10,000 asset. So what I need to make this entry balance is I need to record a gain on sale of equipment. And that is $4,000. Okay, so in this case, my entry balance is I have $59,000 of debits and $59,000 of credits. Okay, so the tricky part about this question was realizing that you could only depreciate up to the residual value of $9,000. Okay, so that's it. Thank you very much and good luck.